so I'm going to be presenting today on growth and value investing. Okay, so first of all, have any of you guys heard of what is growth investing? Do any of you guys know? What is it? Oh, okay. Do you know what value investing is? Okay, so basically, growth investing is when you'll invest based on the potential growth that a company has, whether it has like strong growth potential or whether it has the ability to capture like a large size of the market or just any other factors relating to growth like earnings and revenue. Value investing is more short term, where you'll invest in stuff like things that are below their intrinsic value, and you'll be looking to get like a quick gain, long gain. It's usually just a quick, short return where it'll go from below its intrinsic value to above. So I'll start with the history of value investing. So the origin was about like the 1930s. There was a guy named Benjamin Graham, and he's considered the father of value investing. He was a professor at Columbia, and he was Warren Buffett's mentor actually. So he wrote two books called Security Analysis and The Intelligent Investor. Both of those books are pretty good. They're really insightful, so check those out. And basically what he advocated for was maximizing sustainable returns over the long period while minimizing your losses. So he invested pretty safely, and I think he outperformed the market by about 9% for a period of like 19 years during his time. So he was pretty successful, and he was able to teach Warren Buffett his methods too. The evolution, so there were many other of some of the best value investors, including Warren Buffett, Seth Klarman, and Joel Greenblatt. You might not have heard about them, but they have their models and valuations under their name. And also, recently, there's been a lot of technicals and quantitative strategies where investors have been able to refine like the basic intrinsic value strategies to get like the more refined predictions. Okay, yeah, so Benjamin Graham, he introduced the concept of the margin of safety, which is like the difference between the intrinsic value and the actual stock price. So say if a stock price was about $100, and what he would say is using about what he used, which was like 30 to 35% margin of safety, he only bought the stock if it was at 60 to like 70 to $65, and that basically allows you to buy at like low prices where you know the price should go up in the long run. Also, he used like price to earnings, price to book ratios to determine the intrinsic value, and there's a formula on the next slide. He also created like stock classes where there was like defensive, enterprising, and NSAV net, where he was able to classify those with different formulas. So Warren Buffett, he focuses on companies with healthy balance sheets. So he'll look at companies, he'll read their balance sheets, their earnings reports, he'll read their annual reports, and he'll see what the company exactly is up to. He'll look at companies with economic moats, which means they have a competitive advantage in what they do. So whether that be like Amazon and it's the first in e-commerce, or right now let's say Nvidia, it's the best in like GUIs and computer chips. And basically what he did, Warren Buffett, he got rich by just buying and holding for the long period and just riding it out until the actual stock price reached its intrinsic value. Seth Klarman, he was another like notable person. He didn't invent contrarian investing, but he made it popular in that like he basically bought when the market was at the opposite of what most people were. So say the market would crash, most people are now panic selling. He basically introduced the concept of basically like going all in and buying at that point. And it's basically proven very helpful, because that's where most of the returns are when the market is like, when it's going the opposite direction of where the public's going. Then there's Joel Greenblatt's magic formula. I'm not exactly so sure what that is, but what he does is he has like a complicated formula with like multiple factors that basically they find undervalued companies with strong balance sheets, and then he looks specifically at the return on invested capital and their earnings to see actually their money, not the product, not the money they get from the product, but rather the money they actually have in their accounts, and see how strong that's improving. And basically this strategy, I guess it's outperformed the benchmarks over the last 50 years. So here are some of the value investing models. We did the DCF last week. I'm pretty sure you guys looked at the DCF, right? Okay. And so that's just the simple DCF formula. There's also this value formula. That's the dividend discount model, where it basically projects like the price, the growth, and then the dividend. And like the companies with the higher dividend growth, they basically expect them to just keep on improving, because a company will only give a dividend if they're very strong and like their fundamentals are strong, and if their dividend's improving, that means the company is pretty healthy. So that's how they get the value. And these are all simple formulas. Like this one right here is Benjamin Graham's formula. It uses earnings per share, and then it uses the growth rate, and then like the safe return. So Y would be like the AAA corporate bond yield at the time, which is like I'm pretty sure it's like 4.7 right now. But if you do that formula, you'll get an intrinsic value on the stock based on its growth, current earnings, and like safe growth rate. These two are more complicated. I'm not sure if any of you guys have heard of it, but it's called the Fibonacci retracements. And basically what it is, it's a technical indicator that has like, you'll start with like the stock price, say right here, and then it'll create like Fibonacci models with like, I'm not really sure, but it's higher level math. And it'll create like ranges for the stock based on like where the stock could go. And like if you can see, like the red to blue is like, so this blue would be like highly undervalued, and red would be, say, highly overvalued. So you can see that I guess this stock would be pretty fairly valued. And it's a really simple model that you can just plot, like I guess you can just do like 2 clicks on like TradingView and you'll get the Fibonacci retracements. And it's pretty helpful. You can switch the parameters and make it more efficient as it goes. This is the 3-step DCF. You put in like a lot of parameters, like the weighted average cost of capital, growth rate, terminal growth rate, revenue, earnings, and so on. And you'll see like it's very effective in predicting stock price, because it gives you so many factors that it really can tell you where exactly the company is going. So now we'll go to the history of growth investing. So just check out what are the differences between growth investing and value investing. So the origins of growth investing, the first thing was the Fisher-Scuttlebutt method, and that was created about half a century ago, where Fisher, he basically created this method to find like companies with strong growth. And he basically, at the time when there were like no computers, he had, it was only qualitative research. So what he would do is he'd try to gather as much as information about the company from the company itself. So say you talk to the employees, read their articles, check out their product maybe, and see like how the company is doing from there. Also, it's important that it targets innovation, because that's the main thing about growth investing, that you want the company to grow really fast and outperform, like, say, the normal industry growth or sector growth, and you'll get that only if the product is like hot in the market. Okay, also during the Second World War, the American economy was able to reset after the war ended, and that's when like all these innovations and growth were able to happen after they had stopped focusing on the war. Okay, so new growth stocks, basically there was these stocks where investors are emphasizing the revenue growth rate, earnings, and then the market share expansion. So how fast it's like getting out in its industry and its market, and like how much it can take over a long period of time. There's also like small and micro cap stocks, and these are important because they're the stocks that can really increase the most. So if a company is worth like $2 billion, it'll be hard to get to say $4 billion, but if a company is like 300 million, to get to a billion, it won't require as much effort and like actual work. Like it'll still be a lot of work, but it won't be as much. Like the effort, it won't be double. Okay, so some developments. So there have been a lot of times where growth companies and basically times in history where the growth was like too high over a long period of time and it caused bubbles. And so the airplane, when they were introduced in like the 1940s, the retail frenzy in the 80s, and then the internet boom in the 2000s, and the tech and AI revolutions in the 2020s. And during all of these times, you can see the major growth stocks, those were the ones with the highest returns. So like right now you can think the internet boom, what came out of that, like Apple, Amazon, the tech AI revolution, we'll see maybe in the next 10 to 20 years, like which companies come out strongest from there. Recently Nvidia has been doing pretty strong, and then in the retail frenzy was also Amazon. So growth investing, it's changed over time, because while in the beginning it was just companies with strong revenue growth, innovation, right now it's more like holistic, where they look at not just the company itself, but like compared to other companies, like its market expansion, and like what it's actually doing in its industry, whether it's able to expand into other industries. Yeah, that's the most important part. So here are some notable growth investors and their models. So Peter Lynch, pretty sure he's the most famous growth investor out there, and he has a growth at a reasonable price model, which is his philosophy to invest in companies with strong growth potential, but as well as like actually good current prices. So, okay, and historical growth. So they're just companies that are overall doing strong, and it's really important because you can buy a good company, but if you don't buy it at the right price, then it's all gonna fall apart. Like if you're buying at the top of a bubble, you can buy Microsoft, you can buy like Nvidia, Amazon, whatever. But if you're buying it at that price, then you can only be expected it to come down. Also, he used a bottom-up approach, which is basically instead of looking at which industries and sectors are doing well, you look at certain companies. Like which companies do you know? Like for example, if you have a gaming PC, you'll look at Nvidia maybe, see what they're doing. If you maybe play like games and stuff, you'll look at maybe like Hasbro and like those type of companies. If you maybe eat a lot of like fast food, you'll see what your favorite fast food companies are doing. Actually, it might sound funny, but that's how he got most of his money. He made I think he made like millions off of Dunkin' Donuts when Dunkin' Donuts was just starting out, and that's just because he saw the long lines in the Dunkin' Donuts, like in Dunkin' Donuts at the time. There's the introduction, so the scuttlebutt method, and that's basically so as I said, it was an approach that relies on getting the information from the company itself, and like from the company, their people, like employees, the articles, products, whatever. And it also stresses that the companies need to have strong long-term growth prospects as well as like good management. Because if a company has like bad management, then it'll fall apart soon, right? Even if the company is not that good but is well managed, it could turn into a strong company in the future. Lastly, there's the William O'Neill CAN-SLIM system, and basically that is it's a newer model, and it integrates like long-term technical factors as well as fundamentals to find like where the growth is possible. And it mainly focuses on earnings and growth like all of these do, but it also stresses innovation like the scuttlebutt method. And it stresses, like, as I said, to buy at the right time, because if you can buy a good company at a good price, like, that'll be the best, right? But if you buy a good company at a bad price, then your returns might not be as strong, whether, like, if you had bought like a bad company at like a good price, say. Okay, so here are some growth investing models. So this is called the Gordon growth model, where you put in like the dividend, then you put in the growth, and then the rate. and then over a period of like, actually whatever period you want, and then you can see like what its returns will be. Most people usually do a period of a year based on like the annual returns and like the growth rate per year, but if you can accurately predict like the growth rate every year, then you'll be able to see a very accurate prediction of the stock price. Next we have just some simple technical indicators. Like this is just like, I think I'm blanking, but it's like a momentum strategy where you buy at like a certain like simple moving average level. So it's like, say when the graph crosses like, so if you see this orange line, whenever the graph goes below it, then you buy at that moment, and you'll see that you only buy when the market crashes quite a lot, and it can be very profitable when you're looking for long-term growth. Also, here's like another thing people use, like they'll map out all the different growth rates and then rate of returns that the company could have, and they'll see like the chances of each of them and like how to maximize it. And this is actually extremely recent model. It's called the Monte Carlo simulation, where I'm not sure exactly how it works, but it basically uses a lot of random factors to see the chance of everything, like of all the possible outcomes and all the returns. So it's like, say, it's a bit cut off here, but if the stock price starts, say, here, then it'll run like millions, billions, trials, whatever, and it'll see like where the range of like where the stock can go, and like the probability of like each of those happening. So say it has like a good chance of getting like a 50 to 60% return in like a couple weeks or months, then you'll know about that. And if you even do like the longer term, it's still accurate because it randomizes everything, so you'll know exactly like which range it'll be in because of that randomness. And that's important because not many models have that. Like all of these models, whatever it is like whatever price you get, it'll just be what you get. And when you change if you change the growth rates, you'll get like very different price targets. So Monte Carlo simulation's the most accurate, but it was only invented, I think, like a few years ago because like the AI heuristics it uses. Okay, so the difference between value and growth investing, there's two things between any investing strategies, and that's the time frame and the risk tolerance. So based on what I've said, can anyone guess which one is more risky, growth investing or value investing?
Growth.
Yeah, exactly. So growth investing will always be more risky because you're targeting innovation and you're predicting a lot more factors. Like if you saw the formulas for growth investing, you're predicting every single growth rate, and obviously you can't get that right all the time. And that, like, if you pick a growth rate, like I've tried testing it. If you have, like, for past values, if you have the right value, obviously you'll get about the good range of where the price should go. But even if you're off by 1% or 2% on the growth rate, the variance could be like 20 to 30% on the stock price. So that'll be like that's obviously very risky. And the risk tolerance, which one? So the time frame. So long term versus short term. So do you think you would use value investing or growth investing on like a long term set? Okay, so
You're looking for a quick.
the answer could go both ways, but what I'm gonna say is growth investing is investing in the long term. Like a company, you're trying to maybe buy a company when it's a small cap or micro cap, and just hold it until it becomes like a mid or large cap. And so growth investing, it turns out that is mostly in the long term. So say like early investors, those are considered growth investors, and value investors, however, they invest in the short term mainly because they expect the price to go from its below the intrinsic value to maybe the intrinsic value or above. And usually when the market's like unstable, it doesn't take long before that happens. So say let's take an example. When the market crashed in March 2020 for like, I don't know, about a few weeks. In that few week period, if you had realized that the markets were like that they were undervalued just in that time period, and you had realized, say you had realized that the pandemic despite whatever news had come, would not really affect the stock price in the long run, because maybe the pandemic would only affect for like a few months. It couldn't have affected in the long term, like on a 5 to 10 year horizon. So buying those growth stocks when they were down like 30 to 40% could have been a good growth opportunity that you could have gotten in the long run. But I meant like a good value opportunity because it was below its actual value. And so here we're looking at the value of $100 invested in growth versus value and mid and large cap stocks. So if you can see from about 1980 to 2025, 2024, I guess, you'll see that the best is the small cap value. And you can read it anywhere, but they say that the best funds that you should buy if you don't have that many options, say like in the retirement accounts, the 401ks, the IRAs, those accounts, the best ETFs to buy are like the small cap value. Those overall have had the highest return in the long run. And here we'll see like the growth and value performance. So this is the growth, this is the value stocks, and this is their performance like differential like over the last let's say 30 years. And what you'll see is that the growth stocks, they're like it's more green and it's more red, which means the magnitude of their rises and falls are much more because they're smaller companies and you don't exactly know what's going to happen with them. So these companies could say in this year they could go down like 30, 40, 40%, but then the year after that they could rebound like 20 to 30%, like just like that. Whereas value stocks, they tend to only move like very slowly and it takes time to like actually get the value out of them. So yeah, I just want to talk about like what this means for today. Like what are the implications that the growth and value investing dilemma have today? So obviously, where's the institutional money? So the institutional money is basically where all the big banks are. Like the institutional money is like the big banks and like where they put their money. Whereas the retail investors is people like us who put their money wherever, I guess. And basically, these are some of the 2024 outlooks that were they were compiled in December by some of the biggest banks, where they're basically saying what they think is going to happen for 2024. And while we are 3 months in, let's see like where exactly they thought 2024 was the year of, because I think there's like a pretty strong correlation of what they think of whether growth or value should be better. So let's see, Morgan Stanley, they believe in like high quality fixed income and government bonds, as well as emerging markets. So the high quality fixed income, that's really income investing. It's not growth or value investing, but I believe it comes under the category of value investing because they're looking to just ride it out over the long period. As well as government bonds in emerging markets, that sounds more of like a growth type investment because emerging markets, they're always fast growing if they're doing well. If they're just developing countries, then that's a different story. But emerging markets are countries like India and some other like European countries, I guess. So Bank of America, they also recommend fixed income and then small cap stocks and emerging markets. I thought it was surprising that it was quite similar to Morgan Stanley. But it's basically just the same thing, a little bit of growth, a little bit of value. And then JP Morgan, they said international equities as well as real estate. So international equities are obviously stocks on the global markets, and those tend to be a little more riskier than U.S. stocks, just because the nature of the global markets and the various factors that play into that. There are a lot more factors, obviously, on a global level, like what each of the countries are trading with each other, how they're doing, and for real estate, real estate's always been like, it's not exactly growth or value, but it's one thing that JP Morgan suggested to basically stay safe under like the economic instability. And lastly, BlackRock. They had short-term and inflation bonds, private credit, and high alpha stocks. So it's kind of a mix all around the place where they've got their safe investments with the inflation protected bonds, and private credit, as well as the risky investments like high alpha stocks. And basically, high alpha stocks are just companies that are expected to get the most reward, and they don't really look at the risk on them, which is the beta. So alpha is like the expected return, beta is like the risk that entails with it. And so BlackRock, they're just giving like a good balance of each. So I thought it was interesting that all of these companies are looking at like a good balance of growth and value, but I feel like what they've said in their outlooks is that growth is actually less than value for 2024, and that they do expect that value stocks will be more prominent and that they'll rise because of the run-up that growth stocks had like in 2023. Yeah, so thanks for listening.